Everyone, and welcome back to the video series on market timing. Today, I'm going to focus on contrarian trades, contrarian strategies rather. Contains like a couple of trades that you aggregate into one contrarian strategy. And I will talk about a very specific type of contrarian trade, which I will shortly outline to you. So, to begin with, mean reversion or contrarian, I take them as actually the same concept. You actually see those mean reversions in many asset classes, whether it's in equities or stocks, in fixed income, for example, corporate bonds. So there are people who actually do mean reversion trades or contrarian trades in corporate bonds. Sorry, this is not core. Yeah, that's fine actually. Corporate bonds, and you also see it in sovereign bonds and even MBS, mortgage-backed securities. Okay, and then of course you have FX, and this is actually a very, very famous one. It's called the carry trade, but I won't go into it, but quote unquote, that's the carry trade. So mean reversion contrarian trades are present in many asset classes. And then if you look at like these myriads of contrarian like trading strategies, you will come across examples of strategies that are more short-term. For example, milliseconds, like high-frequency trading, to relatively short investment horizons, like a day or a week of holding periods. Today, however, and in the next couple of sessions, I will be talking about an example of a very long investment horizon, in fact, of 10 years. This is not to say that this is the only one that works, but it's publicly available. Like there are research papers, and they are describing like the way contrarian trades can be implemented very nicely. And I will just walk you through these in these next video sessions, illustrating it with like long-term horizons. The problems that one may encounter trying to implement contrarian strategies are, I would say, not exactly the same, but very similar. So we'll see some of them. And then I will focus on stocks. I will illustrate this example of contrarian strategies with the help of stocks. Now, with contrarian trades, you always have a starting point. And that starting point is telling you whether a single name stock or a single corporate bond or a single mortgage-backed securities is either rich or cheap. And when the signal shows that this single stock is very rich, you go underweight that stock or underweight that financial asset, whatever it is, okay? And that can be just not entering into that trade, just leaving out of your portfolio, to actually outright shorting it. And vice versa for any assets that are indicated by this RV metric, and we'll come shortly to what that could be. When that RV metric shows that these asset is cheap, then you would actually go overweight. That could be just including it in your portfolio to actually go overweight using some leverage. And let's say if you have $100,000 in your portfolio, you will be going long or overweight like $150,000 of all these assets that are indicated as cheap. So you would be actually even using some leverage. And often what tells you what is rich and cheap is based on some kind of historical data. So you look back in time, and then you look at what's the value today, how is it how does it compare to the past? Again, it depends on investment horizon and your frequency, but in our long-term context, how does it compare to the last 10 years, 20 years, even longer, like 60 years, for example, if you have enough data? And if that metric, that RV metric, shows as overvalued, you would then trigger these strategies that I just highlighted here, going underweight or overweight. So in the equities or like the stocks sector, what are like the commonly tracked RV figures? We have a very like well-known one is like the price-earning ratio, and that is calculated both for like individual stocks, single names, as well as for like an index such as the S&P 500. Another one that is an alternative but very closely related to price-earning ratio is the Shiller PE ratio. And the difference here is that while the price-earning ratio is looking at what is the stock price today versus the earnings, the latest one available, let's say from the last quarterly call of a company. It takes that ratio. Whereas in the Shiller one, it's also called cyclically adjusted. It's also known under CAPE, cyclically adjusted price-earning ratio. It is actually looking at the last, I think the previous 10 years of earnings, takes the average and then compares that to the actual price. Then another one is like price dividend ratio. That is a metric that was used in the past very frequently. And the reason why it's not used so often today is because many companies changed their dividend policies in the past couple of years, from paying dividends to their investors to repurchasing stocks. So P/D ratio used to be a very commonly used metric. It's not that widely used nowadays. Then let me see. And then, yes, price to book is another one. So that's price to book. That's the ratio of the current stock price to what is the book value of the stock. Again, that can be applied to single names as well as an index. Okay, so these are commonly tracked RV metrics. Before I go into like in particular into the Shiller, the CAPE price earning ratios, I would like to show some other metrics that are like widely used in like these kind of RV models. I already highlighted like the dividend price ratio. It's just the inverse of the price dividend ratio, or dividend yield, earnings price. I mentioned all those, book to market ratio. But as a matter of fact, if you model relative value as of today, looking back in time using historical data, there is nothing that prevents you from also using like many other factors, for example, macro-related factors. What's the current treasury bill rate? How did it change in the previous 3 months or 6 months? What is the long-term yield? Not that there is necessarily a very clear correlation between treasury yields and stock value and stock valuations, but there are regimes where such a relationship actually does emerge. So there is nothing wrong with including macro variables of that nature. Also, when there is some stress in the markets, like cross sector, even though your focus is on stocks, there is nothing wrong in also looking at, for example, the corporate bond sector. What are the spreads, the investment grade spreads over high yield spreads, or what are the IG spreads over treasuries, and then also inflation. So there are the possibilities are endless. There are so many variables that are worth looking at, tracking, and that gives you that gives you like many possibilities to model rich cheapness. And that's actually a blessing, but it's also a curse. And the reason why is, so historically you can somehow fit like let's say a return, some future return as a function of like all these factors that I mentioned, right? And then you have some error term. So that's a very simplistic regression model. And so this could be like a 1 year, that could be like a 1 year stock return of a single name using historical data. And this could be like the price earning ratio, and then some macro variables that I mentioned earlier, et cetera, et cetera. And this could be like a very rich data, right? You could have just 3 variables to all the way to like, I mean, possibly like even 100 variables. The problem, however, is that, and just bear in mind that this is indexed as T. So let me just talk about hindsight bias here, right? When you model such a contrarian trading strategy, what you will do is, if this is your timeline, then you will be using all the way up to time T, you will be using all the information that is available here. So that's your XT. It could be the time as of, or the data as of time T, but also like cumulative data from a more historical date up to time T, or like a change from let's say this point to this point. And what you do is you then predict your, and this is T plus 1, you then predict your stock returns in the future, right? So that's avoiding the hindsight bias. You use data up and until the period of time T to predict some future change. And I saw people doing quite the opposite, where they looked at, and that's the hindsight bias, where they actually, and that's actually very silly, because that's not real world situation, in the sense that they were using data up to T here, and then they were using the return from T minus 1 to T. And they were using all the data that was available up to the end of this period here, XT. But that would mean that they would already know how the returns played out using information up to the end of the investment horizon. And of course, when you have this hindsight bias in your model, you would have tremendously strong results in your model, tremendously strong predictive power in your model. And that is just an artificial situation of this hindsight bias. So that is just one example that illustrates that, you know, it's actually very obvious. It's very, almost say, I wouldn't say trivial, but there are actually a lot of people, when I interview people for a quant position, and I ask them to outline a model to, for example, predict stock returns, they often fall into this trap of hindsight bias. Okay, but that's not, if you are like real life trading these models, you should always make sure that at least historically you are avoiding this hindsight bias, that you use data up and until, let's call this the present time, to then predict future returns. Okay, so these are future returns from the point of view of all the data that you have available as of today. And you have to do that in your models as well as you do it, obviously, when you're trading. Okay. Another thing I want to highlight is what I mentioned earlier. So you have, let's say, future returns that are modeled against current data. And this current data can also include past information. And then you have some error term. The problem is once you have, let me just pull this up again. Once you have like this, and this is actually quite a limited set of factors, of variables. But once you have a very, very rich data here, let's say you have 10 or 20 or even 100 factors or variables, explanatory variables to predict future returns. The problem with that is that you actually may be overfitting your model. That even if you are not falling into this trap of hindsight bias, historically speaking, you actually may still use too many variables. You will have a very rich set of factors here. You will use a lot of these factors to predict future returns. And in historical time samples, it works very well. But then when you go live and trade these, they actually often fail.